All right, Brian. So we've talked about education is risky, but it may be worth it. And entrepreneurship is risky and it may be worth it. And real estate is risky and it may be worth it. But this next one, I get really, really excited about because this one is risky. It is certainly risky, but in our opinion, the ROI substantiates that this is something I think most people should participate in. And it is stock market investing.
Yeah.
It is buying liquid available securities and investing over the long term so that you can have your money work harder than you do.
Now, this first one, because this is why it's risky, is that there are a lot of people that are worried that the stock market doesn't always go up. And that's true.
Sure.
I mean, 2022 was a year where the indexes were down in some cases over 20%.
Yep.
That's scary.
If you look at the S&P 500, again, it's just the largest 500 companies in the United States. From the year 2000 all the way now until 2023, there have been significant downturns. There was the dot-com bubble bursting in the early 2000s. There was the Great Recession of 2008, 2009. There was fourth quarter of 2018, which was a greater than 20% drawdown. There was COVID, where there was this huge drop. And then, of course, there was 2022, which is an extended period of low performance on the market. So it does not always go up. There are periods where it can be volatile. And there are periods where you open that monthly, that quarterly account statement, and it doesn't feel great. It doesn't look wonderful.
Well, and that's the risk of the S&P 500, which is the 500 largest U.S. companies. What about the risk of people who are chasing the hot dot of, think about it. If you work, there's a lot of people out there work at technology companies. So their human capital is tied in with their investment capital. And I firsthand, I can tell you, I worked with a lot of executives back when I was in Atlanta working for another firm with Lucent executives. And Lucent, a lot of you younger are like, what? What's Lucent?
What's Lucent?
Lucent would be one of those top 5 whole, it was everything. Everybody wanted to be in Lucent. It was a high flyer in the early 2000s. And the reason you've not heard of it anymore is it's gone. It is. So anybody who is, if you were an executive or an employee that was encouraged to invest not only your human capital, but also your investment capital, when it went under, you lost it all. So there's definitely some investing traps if you concentrate or take too much risk, even with equities.
So market doesn't always go down, and it's very easy to get yourself overextended. It's very easy to get yourself in a bad situation. So if that's the case, well, why do people do it? And I think the number one reason that people like to do stock market investing is because it has been pretty consistent over time. If you look at the broad indices, we're talking about just buying the index, it's offered great returns. Since 1960, the S&P 500 has annualized just over 10% per year. That's 10% while you don't have to go out and pick individual stocks. You didn't have to look at balance sheets. You didn't have to pore over financial statements to figure out what to do. If you just bought the market itself since 1960, you would have annualized greater than 10% rate of returns without having to have a finance degree or be some specialist figuring out what's out there.
Well, the other thing I like about and why people do this is that if you just instead of trying to beat the market, just invest in the market. You don't have to have a lot of knowledge to just go buy an index fund.
Yep.
I mean, that low barrier to entry where you can automate the process and just buy the essentially the economy and what's going on in the human experience of always innovating and ever evolving law of accelerating returns. That's easy.
Yep.
That's something that you can jump into very easy.
And I love, Brian, when you say easy, it's also, in our opinion, the easiest path to wealth. We do this annual survey of our millionaire money guy clients and family to ask, okay, what were the things that you did? What were the characteristics that you have? And one of the things we ask is, what was your path to wealth? How would you describe how you got to where you are? And what's really, really interesting is 69% of our respondents, 7 out of 10 of them from our most recent 2023 survey, said, hey, I'm just a saver and investor. I take a little bit of my earned income today and I invest it to put it to work for me so that I can have a great, big, beautiful tomorrow. It's not the entrepreneurs. It's not the senior executives. It's not the super talented virtuosos. It's the everyday millionaire next door that recognizes I can just put a little bit of my money to work and it can do amazing things over the long term without a whole lot of brain damage, without a whole lot of hard work.
So a lot of people are going to be intrigued. They're going to watch this. They're going to want to know, how do you do it right? What's the first thing I think about, Bo?
The first thing would be, just like you said, don't chase the hot dot. So often we get caught up in, okay, well, what stock do I go buy? Or what's the top performing mutual fund? Or what's the next hottest thing? We think that rather than trying to beat the market, you should just be the market, because what matters more than timing the market is time in the market. So if you can avoid the hot dot and just do boring, plain old low-cost index fund investing, you're likely going to set yourself up for a lot of success.
Yeah, I think there's an interesting clip going around with a really popular guru talking about how easy it is to beat the market, but the reality just doesn't support that. If you look over the last 10 years, according to Spiva, 93.1% of domestic equity funds underperform the index. Guys,
that's 9 out of 10.
That's overperformance. So instead of trying to beat the market, just be the market, because that's overachievement. If you're beating over 9 out of 10 investors out there who think that they have a better mousetrap, and by the way, even if you're part of that 6.9 to 7% that do outperform, there is consistent research that shows that there is not consistency to that. I mean, I saw it on social media, somebody did a search to figure out how many funds had a performance, an overperformance for the last 20 plus years, so from a consistent basis. It was 5, not 5%, 5.
1, 2, 3,
so
4,
I mean,
5.
and all those funds had restrictions and other things. Guys, being the market is potentially a great opportunity to just capture what's going on with innovation, technology, and this growing economy that we all are surrounded with.
And right now, being the market is easier than ever. Look at low-cost index funds, whether that be something like the S&P 500 or some other index you're looking at, or maybe you just use a target retirement index fund where all you have to decide is, how much do I want to save? And then what year do I think that I'll need the money? When do I think I can retire? And you'd be amazed at just solving for that very simple piece. You can set it and forget it and build automatic wealth, which is amazing. You don't get lost in all of the things that you can get lost on, and focus on those things that are actually important.
So I know a lot of people, when they first go down this path of thinking about investing, especially in equities, they're like, man, okay, these guys have given me a lot with this. Well, I'm hearing the terms index funds. I'm even hearing index target retirement funds. But how do I know which accounts? I know there's, once you get past even how I'm going to invest, is this a Roth account? Is this a regular retirement account? Is this after tax? Guys, that's why we talk about the financial order of operations, because this is what's going to help you. If you go to moneyguy.com/resources, it's not only going to get you into the different investment accounts, whether it's tax-free or regular retirement or even after tax. It's going to help you figure out the beginning stuff. Like, how do you protect yourself by having enough cash, like your highest deductible covered, as well as emergency reserves, getting that free money from your employer, as well as paying off the high interest debt. Take advantage of the free stuff we're laying up for you. There's also a whole page. If you don't just stop at the foo. We have an entire library of free resources you can lean into to accelerate and maximize your journey to success.